So then we start to relax our assumptions, and we really start to think, well, instead of dividends, what if we say, well, what if we look at the earnings per share of the company? That would be another approach. We could say, well, instead of the dividends that the company pays, maybe we could assume that they could pay out earnings. All right, so then we would say that the price of a stock is equal to the present value of all the future earnings. And then we say, but the problem with earnings is that we know there are a lot of accounting entries. So there are non-cash items that get subtracted, so that's going to really mess us up from a time value perspective. And then we subtract things like depreciation and goodwill and amortization. So where we come down with is say, well, instead of the dividends, instead of taking the present value of the dividends, we take the present value of the future cash flows. And so maybe we say the future cash flows to the equity holders, instead of discounting dividends, instead of discounting earnings per share, we discount the free cash flows, kind of an estimate of what the company could pay out in dividends if they chose to do so. And then that gets us, something a lot more tractable, free cash flow to equity. So we could, we relax some of our assumptions that it has to be cash flows that are actually paid to the stockholders and maybe change it to what the company could pay to the stockholders. And then one of the things we know with free cash flows to equity, even that companies adjust a lot. And so another approach that we could take, instead of discounting the cash flows to equity, we discount the free cash flows to the firm. So instead of the cash flows that equity holders have claims on, we discount all the free cash flows generated by the firm. And then when we go to cash flows generated by the firm, instead of discounting with a cost of equity, we discount with a weighted average cost of capital, a return that satisfies all our investors. Then we can get the value of the firm. We subtract the value of debt to kind of back into our value for the stock. So this is the kind of the theoretical underpinnings for valuation, and we certainly are going to have cases where the dividend discount model, just discounting dividends, gets us a place. It can be very useful for companies like utilities and REITs that pay a lot of their cash flows out in dividends. But often we're gonna do something else like a free cash flow to equity or free cash flow to the firm model.